Jobs Day again tomorrow. Our next guest says unemployment is very important. Mark Eibel, Director of Multi-Strategy Solutions at Russell Investments, joins us now from Tacoma, Washington, to discuss market findings from a recent survey he conducted. Mr. Eibel, welcome. Thanks for joining us.
Thank you.
I think so many people are zeroing in on jobs. Obviously, this week very important with the unemployment reading tomorrow, but just also because of its role in economic recovery. In fact, Chairman Bernanke in his testimony before the House Financial Services Committee this morning saying even if we do achieve 3% growth, it's still going to take, that's still not enough to bring down unemployment. Your thoughts?
Yeah, that's consistent with our views as well. We see tomorrow's report coming out somewhere around down 150 to 160,000 jobs is our estimate. I know consensus is about 180,000. But job growth, remember, we have two bogeys we really need to get towards. One is just zero. We're not gaining jobs, but we're not losing jobs. We think that happens closer towards the end of the year. But to get back to job growth to where the unemployment rate goes down, you need to be adding 150 to 180,000 jobs a month. And that is something we don't see happening until the earliest the end of next year and very possibly into 2011. Now so our observations are this economy we are leading out of it, but unemployment is going to be an issue that people are going to be reading about for years to come.
Tell me if this is positive for the jobs market. Richmond Fed's Jeff Lacker is speaking in an interview right now with Bloomberg Radio saying that consumers may be ready to open their pocketbooks more. He says the interest rate timing depends on consumer spending outlook. That's probably no surprise. But that Lacker, again, is heartened by today's personal spending report. Spending and incomes rose more than expected. That's what he's referring to. Is that good for the jobs market or generally the broad economy?
Yeah, I think it is good for the broad economy. I mean, the consumer is kind of on shaky ground right now. Unemployment and housing are two things that they're going to look at to say, am I going to be more comfortable spending? The spending report today, that was encouraging. However, I know there was another report that said credit card delinquencies were up and higher than they were before. So I think the consumer could go either way, and unemployment at least needs to stop going down. For the consumer to feel a little bit better, housing seems to have bottomed, and I think those are the two things that will really drive the consumer from here. At some point, and I think it's great that people are saving money, but at some point they will start spending again. I just think it's going to be slow over time and not back to the level certainly that we've seen in the past.
Oh, Mark, you're a little cautious. A couple
I am
of
a little
things
cautious.
Out of the Lacker interview, if you would be so kind as to react to. GDP may have expanded 2.5% to 3% in the third quarter. He says that expansion should continue. The risk of a second dip is smaller, and that's key because earlier some economists were saying possibly a W-shaped recovery. Maybe it's a U. The V-shaped people are kind of moving back off a little bit. What do you think?
Yeah, we're not in the camp of a double dip. Our views are that when third quarter GDP gets reported, it'll probably be somewhere in the 2.5% to 3% range. But that's quite modest compared to where we've come from. Normally, when you have such sharp declines, you do get sharper increases coming out of it. So this one's a little bit different. We're coming out of it just not as strong as we historically do. But our view is 2.5% to 3% for at least the next few quarters and into 2010. Not a W. Maybe we're in the square root camp along with everybody else. But I think they're going to ease monetary policy long enough to make sure that that double dip recession doesn't happen.
That sounds like the plan, according to Mr. Bernanke. Let's talk assets now. Stocks way down today. But generally speaking, the market's really been on a tear. So do you think stocks are overvalued?
Yeah, it's interesting. We do a survey, the Investment Manager Outlook, which we're releasing this week, where we survey several hundred managers, and that's one of the questions that we ask them. And the amount of managers that went from the market being undervalued to fairly valued, it only moved a little bit. About half the managers thought the market was fairly valued. So despite the run that we've had, I think most people recognize that that just got us kind of back to the worst case scenarios off the table. And if we get economic growth, if unemployment gets a little bit better, and again, the housing market bottoms, this market could continue to move up from here. We get an earnings season coming up, but it's probably going to be much more slow and modest from here.
We have about 30 seconds here left in our interview, Mark. So how should an investor be positioned? What should the asset allocation look like? Stocks, bonds versus cash?
Yeah, I think the key and throughout this whole time period of last year and coming out of it into this year is a diversified portfolio. If you're diversified going in and you had a tough year last year, diversification has certainly paid off for you moving out of it. Having exposure to non-U.S. securities, emerging markets, fixed income, not necessarily cash and treasuries, have all been good places to be, and we think that is a logical and sound approach moving forward from where we're at right now.
We're running out of time. Mark Eibel of Russell Investments, thanks for your time today.